Answers to 2017 AP Macroecon FRQ number 2. Related topics: money, banking, and finance market, tools of monetary policy, including open market operation, aggregate demand expenditure model. Assumption number 1. An economy is in long-run equilibrium. As a result, we have short-run aggregate supply, long-run aggregate supply, and aggregate demand. They all intersect at a point. Implication number 1, real GDP equals the potential output and potential with full employment. Actual price level equals to expected price level. Assumption number 2, consumers wish to hold less money because they use credit cards. Analysis: credit card processing functions as a convenient payment method. Payment method is not money, credit cards are not money. It's related to 3 functions of money, specifically number 2, a store of value. Money holds purchasing power over time. So with credit cards, consumers may not need to store physical cash as much as before. Conclusion: assumption number 2 is valid. Let's try to answer each subpart. So part A, let's draw a graph of the money market. The title, money market. On y-axis, we have price of money or nominal interest rate. X-axis, we have quantity of money, and money supply is a vertical line because the quantity of money is independent from the price of money. Moving on, money demands have negative slopes. As additional quantity of money expands, the willingness to pay for the additional money falls, and money demand shifts backwards because of assumption 2. And that's 1 point for this graph. And the price of money, or the nominal interest rate, decreases from R0 to R1, and that is the effect of reduced holdings of money under equilibrium. This is end of part A. Moving on, let's go to part B. Part B, question 1. The prices of previously issued bonds will increase as nominal interest rate decreased. This is the summary of the relationship between nominal interest rate and price of bonds. Note that these 2 variables are inversely related. For your reference, this is the formula to compute the price of bonds. And question B2, in the short run, both the price level and real income will increase. So firstly, the price level increase because lower interest rate will increase consumption and or investment and or net export. Brief interpretation of how consumption investment increases are portrayed on the left side. Net export will likely to increase as well, and as a result the price level will go up because note that aggregate demand is the summation of consumption, investment, government spending, and net export. With increase in the aggregate demand, price level will go up in the short run. The real income will increase as well because note that real GDP computed by the expenditure method is equal to real GDP computed by income method. So in other words, the real income will increase. Moving to next question, part C. Money equation of exchange says that M times V equals to P times Q, and based on answers to part B2, in the short run, the price level and quantity of output increase. With constant money supply, the velocity of money increases. End of part C. last question, D. What was open market operation? Well, it's the purchase or sale of government bonds by the central banks. It's one of the three tools of monetary policy. So take a look at this chart for your reference. So central bank wishes to increase the nominal interest rate. The central bank would sell bonds. So by selling bonds in the money market, the money would transfer from bond buyers to central bank, and as a result, in the money market, money supply will decrease. With decreased money supply, the nominal interest rate will go up, and that is the end of part D. It was answers to 2017 AP Macroecon, FRQ number 2. I hope this helps. Goodbye.